Welcome back to the channel, everybody. Today I want to talk about something very, very simple. I want to talk about volatility. What is volatility? What does it mean for you? Here's the thing. As an investor, volatility is just the movement of the price of whatever asset that you're looking at. That's it. Bigger volatility means bigger swings up and bigger swings down. Lower volatility means smaller swings up and down, which is fine, right? The thing that you want to do is, as an investor, is you just want to make volatility your friend. That's it. You just need to be comfortable with volatility. Volatility is not the same thing as risk. That's very important to understand about stocks in general. People use volatility as a measure of risk. That comes from the fact that people assume that markets are efficient. Markets are mostly efficient, but the efficient market hypothesis leaves no room for error. And I think that's probably the biggest mistake of that hypothesis, is that we know that markets are just made by individuals, and individuals are, frankly, they're not rational all of the time, right? They do things that just they don't make sense, right? From a rationality perspective. They have this thing where, people will gamble, right? Even though a risk neutral or even a risk averse person, a risk averse person would definitely not do the gambling. A risk neutral person still wouldn't do the gambling because the odds are against them, right? And so, people make irrational choices. And I think that people making irrational choices, that sort of correlates with the stock market, and it explains why the efficient market hypothesis just doesn't work, right? People are not fully rational, and therefore the efficient market hypothesis cannot always hold true. I think that it mostly holds true. So let me dovetail that in there. The efficient market hypothesis, markets are mostly efficient. For the most part, people act rationally. But then there are times of excessive exuberance where people just do not act rationally. And that's why I end all of my videos with stay rational. It's important to remain rational in the market, especially in the face of volatility, right? So I said something earlier that I want to come back to right now. And what I want to say is that volatility is not risk. Because people talk about the efficient market hypothesis and markets are efficient, blah, 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 the movement of stocks contains all of the information and therefore all of the risk. Therefore, volatility is synonymous with risk. I don't think so. Again, I think there's a kernel of truth to that. But I've been around the block enough times and invested in enough turnarounds in my life that have worked out really, really well to understand that volatility is not perfectly synonymous with risk. And the thing that most people miss is that risk comes from the actual business and what the business does, right? It's it's things like, we have a risk of being sued. We have a risk that this mine is going to collapse and kill a bunch of workers. We have a risk that, we won't be able to obtain the financing that we need. We have the risk that that somebody discovers our secret formula and publishes it. You know, those things are risks. Those things are real risks to a business. And they certainly affect the volatility of the stock, right? But the thing is that those are real risks. And I think you need to decouple in your head the real risks of the business versus the risk of losing money due to volatility, right? Because if you're a long-term investor, there is no risk, right? There is no risk in the volatility, right? It's going to wiggle around and do its thing, but overall, it's going to move in the direction of that the business is moving in. And so you don't worry about the volatility. You take advantage of it, right? That's the point of doing your fundamental analysis, is to figure out what direction is the business going to go over the next 10, 12 years or longer. And if you can sort of project out the direction that the business is going to go, the actual swings of the market become irrelevant, right? It's going to move up and down, but it's going to follow that basic trend line. As a data person, right, there's you basically say something along the lines of that you're going to have some sort of stochastic differential equation, right? If you remove the stochastic piece, it's just going to move as an ordinary differential equation, and it's going to go in that direction, right? And you could project it out perfectly. But then there's the stochastic piece where it's going to wiggle around that movement, and potentially the shocks could affect it as well. But we won't get into that because that's just mathy and weird. But the point is that the market in the short run is a voting machine, right? In the long run, it's a weighing machine. And so what you need to do is you just need to decouple in your mind the types of risks that you're bumping into. The higher the actual business risks is the thing that you should care about, right? Those are the things that can screw up your forecasting, right? Those are the things that make your forecast of where this business is going to go in the future. That's what's going to make it difficult, right? To understand where this business is going to go. And those are the risks that you should pay attention to. How much the price moves up or down on any given day, a week, month, year, it's irrelevant. It's completely irrelevant. The only time that it's relevant is when you want to buy more or when you want to sell, right? That's it. And so what you want to do is you want to do good valuation work. It starts with just reading the numbers to understand, is this stock low enough at the moment to want to do additional research, dig into those risks, and understand, like, where is my forecast? What should I pick as my forecast, right? And so that's what you do, right? And you adjust your initial forecast. You do a good valuation work, and eventually the market is going to agree with you. I don't know how long it's going to take for the market to catch up to you, but eventually the market will agree with you if you've done really good valuation work. That is a guarantee. Now, if you've done bad valuation work, uh, then the market doesn't have to agree with you ever, right? So you need to spend time understanding the risks and what could go wrong with the company that could increase the the volatility that you should care about is the volatility in your forecast, right? That's where the risk really is. And that's what I'm trying to get at here is the more you work at understanding how wide your forecast can be, right? Yeah, are you here, or are you here, right? Um, it could be any one of those three because of my forecast. The more you can hone in on what the actual value is, right? Like the more you can narrow that range and get it down, that defines your circle of competence when it comes to investing is how well can you narrow that range down. And if you can narrow that range down really, really well, the market's going to agree with you at some point. And the problem, of course, is that people have wide ranges, and that's why the stock moves up and down, because you have people coming in and saying, oh, I think a good price is here, and you have people coming in and saying, oh, the good price is here, and it's going to bounce, in between. There's people pointing different prices all over the place, and it's going to bounce in between those two things, right? That's what creates the volatility in the stock price is people's volatility in their forecasts of where the company could be 10, 15, 20 years down the road. So understand the risks of the actual business itself to narrow down narrow it down, right? Narrow down your forecast, and eventually the market's going to agree with you. It just is, because that's what the market does, right? As the future plays out, if you've done it really well, you're going to have a pretty good result. And the thing is that where is a stock going to go over the next day, the next month, the next year? Who knows? Because they only publish quarterly, right? You get 4 data points every year. That's it, right? There are some other things that could come out in between quarterly reports or whatever. But officially, you're only getting 4 data points a year with which to measure, right? And everybody's only getting those 4 data points. So the thing here is that, you need to take those data points and figure it out as much as you can. But the volatility, don't care about what the price is doing. That's just people making their personal guesses as to what this thing is worth. It's not what it's actually worth, right? It's literally somebody else's guess as to what that asset is worth at that time. Volatility it's garbage, right? So at the end of the day, do some good valuation work, and if the price of the stock dips below sort of the range that you've established, then buy it. And if it shoots well above the range that you've established as a fair value for the stock, sell it, right? Take advantage of the opportunity. And that's, I think, the real value of doing good valuation work, is that you can then sit back and take the volatility, right? When the market crashes, volatility in the market increases, right? You can see option prices go up, the VIX goes up, all of that sort of stuff, and you've got opportunities to buy, right? And the efficient market people say, well, the reason why value investors do so well is because they buy volatility, right? They take the volatility risk. And the reason why they're doing that is because we have different definitions of risk, right? And as a value investor, I'm happy to take volatility risk, right? Um, because I don't actually see that as the real risk, right? I'm buying a business. The business has risks, yeah, but the price of the asset going up and down and up and down and up and down doesn't matter to me. It doesn't matter to me because I am buying a stream of cash flows. And that's how you actually know that you're investing versus speculating, is when you realize that you are buying a thing, right? You are buying factories, you are buying uh, cell phone towers, you're buying whatever happens to be the case with the stock that you're buying. It could just be a bunch of computers and a bunch of software, right? But you're buying a business, and that is the thing that you're buying, and the risks associated with the business are real. The risks associated with the actual stock and the price that you're paying, it's not real. Those are phantom risks. And so that's it. That's all that you need to do, is take advantage of the price volatility, because at the end of the day, it doesn't matter. All right. That's all that I have to say for you today. Until I talk to you again next time, stay rational, my friends.